is not financial advice. I'm recording my thoughts about Disney stock. If you have looked at my previous videos, I shared my two portfolios and you will know that I own Disney at about $110 cost basis. Current stock price is about $87, so I'm at a 20% loss, which is very significant. Disney has execution problems, and in addition, they're also involving themselves in politics, which I really do not like. And I wanted to sell this stock after their next earnings on August of 8th. The recent events, such as their CEO's contract extension till 2026 and their plan of spinning off some of their non-core assets, have led me to look into Disney once again to make more informed decision, and that's why I'm doing a valuation of Disney, and in the end of this video I'm going to reveal what I'm doing. Let's look at their current financial position. At the stock price of $86, their market cap is about $157 billion. The revenue in the past 12 months is about $86 billion, so that's less than 2 price to sales, which is good. The net income for the past 12 months is about $4.12 billion, which signifies low single-digit profit margin overall. The current PE is about 38, which is expensive, but the forward PE is shown as about 20, which is a reasonable PE for this company. Let's look at their recent quarter financials. As we all know, Disney has two broad revenue segments. One is the Disney Media, Entertainment and Distribution, which includes all the TV channels, Disney Plus, Hulu, ESPN Plus, etc. And on the other hand, they have Disney Parks, Experiences and Products, and it's self-explanatory. Let's first look at Disney Parks, Experiences and Products. You can see that information circled in a green line. In the most recent quarter, they made about $7.7 billion of revenue from this revenue segment. That's an increase of about 17%. With respect to the operating income, they made close to $2.1 billion with the Parks, Experiences and Products segment. That's an increase of about 23%. So the overall health of Disney Parks, Experiences and Products is good. The revenue is heading in the right direction and the margins are also heading in the right direction. So this is a core business that Disney has. Let's now look at Disney Media, Entertainment and Distribution business. I've included that information circled in red line. With respect to revenue, they made about $14 billion in the most recent quarter from the Disney Media, Entertainment and Distribution. That's an increase of 3%, which is not significant at all. And when you move on to the operating income, it's doing really bad. It reduced by 42%. Whenever you see a number in parentheses, it means that it is negative. So the operating income reduced by 42%. So there is definitely something wrong with the Disney Media, Entertainment and Distribution, and they need to make some changes in Disney Media, Entertainment and Distribution business. So let's look at what's going on in this Disney Media, Entertainment and Distribution in further detail. As you can see on the screen, there are broadly 3 different sub-revenue segments within the Disney Media, Entertainment and Distribution. One is the linear networks, which includes the TV channels, both national and international. Example of that is ABC Network. And the second segment is direct-to-consumer, which includes the Disney Plus, ESPN Plus, Hulu, etc. And then there is content sales, licensing and other. When we look deep into the linear networks, which includes the channels, the revenue reduced by 7% from $7.1 billion a year before. It dropped to $6.6 billion. So we definitely see that the linear networks or the channels, their revenue growth is decelerating. And with respect to their margins on the linear networks, the margins are also dropping. As you can see on the screen, from $2.8 billion operating income a year ago to about $1.828 billion of operating income for the linear network. So that's a reduction of 35%. So linear networks is definitely profitable, but its revenue growth is decelerating and profit is also reducing. So in other words, linear networks is a slowly dying business. It's still profitable, it's still worth something, but it's going in the wrong direction. Now let's move on to the direct-to-consumer, which includes the Disney Plus, ESPN Plus and Hulu. That revenue growth is actually increased by 12%. They made $5.514 billion of revenue And previously, in the same quarter last year, they made about $4.9 billion. So that's a 12% revenue growth. So that's good, double digit revenue growth. But with respect to the margins also, they're still losing money at the moment, but the loss is reducing. In the most recent quarter, they only lost about $659 million. And a year before, they were losing $887 million. So that's an improvement of 26%. As this direct-to-consumer business, it's growing in double digits, which is good news, and their losses are also reducing. That's good news. But there is still a lot of work to do for direct-to-consumer business where they have to get to positive profit margins. Content sales, licensing, and other is also doing something similar to the direct-to-consumer. So when I do the valuation, I'm going to merge both direct-to-consumer and content sales because both of them seems like promising businesses for future of Disney, media, entertainment, and distribution businesses. Before we move on to the valuation, let's quickly look at what Disney can do to get this direct-to-consumer business into profitability. To get to profit, either they can increase the revenue or reduce the expenses. To increase the revenue, they need to get more paid subscribers, but as you can see on the screen, they're struggling to increase the number of paid subscribers. So that is definitely off the equation at the moment. And they can also increase the revenue that they get from each subscriber. As you can see on the screen, they did have some success in increasing the revenue per paid subscriber domestically in the US and Canada, but they are struggling internationally. So I still do not see much difference with respect to the revenue paid per subscriber. So in addition, this is a very competitive market. So the only way Disney can get to profitability, in my opinion, is to reduce their expenses, which they are planning to do. But we have to see how that's going to pan out in the coming quarters and years to come. When I look at the balance sheet, it seems like Disney has $10.4 billion of cash and cash equivalents, but I cannot give them too much credit for this cash because the total current assets are $28 billion and the total current liabilities are also $28 billion. So I'm not going to give any credit to the cash that Disney has at the moment. Let's now move on to the valuation. I'm going to do the valuation in 3 different pieces and add them together. The first piece would be parks, experiences, and products. And the second piece would be the media and entertainment segment excluding linear networks. And I'm going to do the linear networks valuation separately. I have to do the valuation separately for linear networks because its revenue is reducing, the profit margin is also reducing. It's still profitable, it's worth something, but it's a dying business, slowly dying. And on the other hand, I have the direct-to-consumer and content sales and licensing, which is growing but not profitable yet, and it is going towards profitability. So there are 2 different businesses, then therefore I have to evaluate them separately. Let's first move on to the valuation of parks, experiences, and products. In the most recent year, in 2022, out of the $85 billion revenue, almost $28 billion came from the parks, experiences, and products. With respect to estimated growth rate, I'm only assuming 8%, even though they achieved double-digit growth in the most recent quarter. In the coming years, I think it's going to grow much faster, but I'm only going to assume 8%. With that, they can make about $41 billion of revenue in 2027. Their current operating margins are very impressive, 27%. So I can easily assume 22.5% net profit margins, with which they can make about $9.3 billion of net income in 2027. For a company that's growing at 8% and has 22.5% net profit margin, I can assign a multiple of about 15, but since Disney Parks, Experiences, and Products have a moat, I can pay a premium of 20 multiple. I'm not going to pay anything more than 20. So with that, the market cap for Parks, Experiences, and Products would be about $185 billion in 2027. With respect to number of outstanding shares, I'm going to keep 1.82 billion outstanding shares. No dilution, no buybacks. With that, the Parks, Experiences, and Products would be worth about $102 in 2027. Now let's move on to the media and entertainment segment without the linear networks. An entertainment business, excluding linear networks, made about $30 billion of revenue in 2022. And it's growing in the double digits, but I'm only going to assume 10% revenue growth because as the company gets bigger and bigger, it's hard to grow. With that, they can make about $48 billion of revenue in 2027. This is a very competitive market, direct to consumer, and Netflix barely gets double-digit net profit margin. So I'm only going to assume 7.5% net profit margin, which I think is conservative, but I'm just going to keep it that way because Disney direct to consumer is struggling. So with that, they can make about $3.6 billion of net income in 2027. I'm only going to assign a multiple of 15. With that, the media and entertainment business, excluding the linear networks, would be worth about $54 billion. When I divide the $54 billion with 1.82 billion outstanding shares, I get a stock price of $30 for the media and entertainment, excluding linear networks, which only include the direct to consumer, which is Disney Plus, Hulu, ESPN Plus, and the content sales and licensing businesses. Now let's move on to the linear networks, which is the international and national channels like ABC Network. In 2022, they made about $28 billion of revenue, and I'm estimating a growth rate of -5%. As I said before, the growth rate is reducing, and -5% in my opinion is fair. With that, they can make about $21 billion of revenue in 2027. The operating margin for this business is about 28%, so I can easily assume 20% net profit margins, with which they can make about $4.3 billion of net income in 2027. Since this is a slowly dying business, but still a profitable business, I can assign a multiple of 10. With that, the linear networks would be worth about $43 billion. When I divide this $43 billion with 1.82 billion outstanding shares, I get a stock price of $24 just for linear networks. If Disney want to spin off this business right now, when it's doing good, they should get a much better price than $43 billion, in my personal opinion. If they wait any longer, this linear networks business is going to further reduce in revenue and net income, and it will not sell for much if they wait any longer. So in my opinion, it's better to spin off this business as early as possible. But I do not know what's going to happen in future, but in 2027, it would be worth about $43 billion in my opinion, and convert to $24 stock price. When I put all these three pieces together, $102 for parks, experiences and products, $30 for media and entertainment excluding linear networks, and $24 for linear networks, together Disney stock would be worth about $155 in 2027. Currently it's at about $85, so that represents about 82% gain in 5 years. 82% gain in 5 years is definitely attractive. It's going to beat the index, and it all depends on execution whether they'll get there or not. And in the meantime, they can also do some spin-offs which could actually positively affect the stock price. But at the moment, the extension of contract of Bob Iger till 2026 and the news that they can potentially spin off some of their assets, giving me a bit more confidence to hold on to this stock. So at the moment, I'm not buying this stock anymore. I'm going to keep my stock at $110. I'm not going to average it down. Let me know your thoughts in the comments. Thank you so much for watching.